Hey, I'm Chris Parrish, Chief Investment Officer with Oak Harvest Financial Group here in Houston, Texas. We usually just release a weekend update on Mondays, but given last week's volatility-laden sessions, coupled with our recent release of first half 2022 outlook, I thought I would combine all of this week's material into one short video release. Let's call this Monday Mashup, much like the market action last week. Equity markets were broadly down last week, with the S&P 500 down about 1.2%, now placing it about minus 3.5% off its closing November 5th high of 46.97. If one were perfect, and listeners, no one is, not even widely respected hedge fund billionaires, from the November 22nd intraday peak of 47.44 to the trough intraday low last week, the S&P 500 fell 5.25%. If you were perfect, which no one is. The real weakness in the markets over that period has come in the areas of growth at any price software and reopening stocks, think of Zoom and Peloton, and energy and material names. What are the attributable causes being thrown around about the recent weakness in stocks? Well, they appear to be threefold. First, the markets are trying to reconcile potential growth hit coming from the Omicron Covid variant related supply and demand disruptions it may cause. Secondly, and more importantly in my eyes, the markets are struggling with the recent comments by Federal Reserve Chairman Jerome Powell and other Fed members, growing realization that monetary policy might be behind the curve, and that they might have to taper QE more quickly and begin raising rates sooner than expected. And third, with the markets suddenly volatile in an otherwise calm time, many institutional investors and retail ETF investors are scrambling to net out their year-end tax positions, recognizing some tax losses in year-to-date losers and harvesting some gains in real winners. Recall, listeners, we released our YouTube video on November 5th with the S&P 500 making new all-time highs, and that was titled, 2 Signs of Increased Volatility Ahead, Getting Jiggy with It. In that podcast, we specifically highlighted volatility moves in the U.S. Treasury bond market, represented by the MOVE Index, leading to periods of equity volatility. The MOVE Index is the U.S. long-term Treasury market's equivalent of the equity VIX index. We pointed out how the MOVE Index can precede 2 to 4 week periods of very fast and gut-wrenching but brief downdrafts in equity prices on increased volatility in equities. Well, now our work is saying that the bond volatility looks to be peaking right near the 4-week mark this week. Right here you can see, this is a 10-year chart of bond volatility. We're going to post this on our website because it's kind of hard to see. But what you'll see is the only period of higher bond volatility was during the COVID collapse in March of 2020. So hopefully we're almost at peak short-term volatility of stocks as well. Many viewers might notice that we just released our first half 2022 outlook last week under the title, Curb Your Enthusiasm, Yields to a Bull Market Buy. Given that we first shot this video pre-Thanksgiving holidays and before the recent downdraft in equities and uptick in volatility, you might wonder why I didn't rewrite it and reshoot the whole thing. Well, I did think about it for 2 or 3 days while I was on vacation. However, I chose not to because every time I read it to myself, I thought to myself, there's nothing I would change except to say, it looks like, if anything, we were off by exactly 2 months. Why do I say this? Well, here's a little excerpt from that outlook, and this is a quote. Quote, our team is seeing the first half of 2022 as a period of higher realized volatility, not just high implied volatility, which is covered in the options market. Even though we believe the bull market will remain alive and kicking in 2022, we expect that fear, rhetoric, and negative commentary on TV and in newsletters to continue and most likely pick up speed in the first half of 2022 as the markets can experience its first correction of over 10% in the last 18 months. How could this play out? Should we approach a parabolic move up in the S&P 500, say reaching 4,900 to 5,000, which we have not yet, we would expect our first minus 10 to minus 12% correction all the way back down to 4,450 to 4,500 on the S&P 500 in a very quick fashion, which of course is where we currently sit. Call it over 4 weeks. While gut-wrenching, should it occur, this would only retrace roughly the last 2 months of our move up in a very quick fashion. We would expect a very sharp rise in realized volatility, with the often quoted spot VIX index rising back to 28 to 30 temporarily, which is where it stands right now, Why? I don't know. As I always say in advance, I can make up reasons just like anyone else. What would the TV anchor's rationale be for such a fast correction finally? I don't know. A few of my early guesses. Here are the early ones. First, the Federal Reserve hints of a faster tapering of its balance sheet or raising rates earlier and some hedge fund blows up, which is a dynamic we tend to love here at Oak Harvest. Well, that looks to have just happened over the last 2 weeks. Secondly, we get a new COVID variant and investors get scared for a month or two. And I think the Omicron variant is qualifying in doing this. And third, and viewers, this is the most likely one, and I know it isn't sexy sounding here, but it could be normal investor profit taking after almost 2 years after the COVID lows as investors finally decide to book long-term capital gains in front of 2023 income and capital gains tax increases. I could see this as a response to our Federal Reserve moving faster at tapering or telegraphing an earlier rate increase at the end of their January meeting. Well, this is exactly what Jerome Powell has done since his reappointment. And of course, this would also probably come just a few days after Ray Dalio from Bridgewater hedge fund fame goes on a global stage at a conference and proclaim cash is trash for the 5th time in 5 years. You know what? That would be the exact normal time and ideal time for a sell-off to begin, much as it did in January of 2018. Viewers, I warn you, Mr. Dalio is now an unheard of, perfect 4 for 4, making that cash is trash claim, an announcement literally within days of our stock markets declining 5 to 12%. 4 times in a row. It's amazing. If you are a tactical trading type, keep your ears peeled and check your calendars for when Mr. Dalio is speaking. Listeners, I wrote all of this before the Thanksgiving holiday break. Listeners, Ray Dalio was on CNBC on November 30th, just days ago, spewing this same cash is trash nonsense. As you can see, much of what we were thinking would happen in late January of 2022 and cause a period of market weakness and higher volatility is happening now. With that in mind, we feel that the timeline has just been pulled forward, but the ultimate outcomes remain unchanged. Suffice it to say, for now, we are sticking to our first half 2022 outlook, and optimistically, since the sell-off we thought would come in February through March timeframe looks to have been accelerated to here and now, we think it's equally as likely that the trough is sooner and not as deep as we reach the other side of this pullback in the stock markets and volatility peaks sooner than we expected. The price action in the MOVE index and the movements in the forward volatility markets the first half of this week should go a long way in telling us if we're going to begin the next major rally, which we expect in 2022, sooner rather than later. But in most cases, we are expecting yet another banner year for the S&P 500 in 2022. Given that the S&P 500 looks to end 2021 at lower levels than the short-term unsustainable ones, which we talked about a few weeks ago, we feel that the percentage rally to the upside in 2022 will be higher than we first projected, and it will be sustainable. From these levels of 4,450 to 4,500 on the S&P 500, we would expect another positive year approaching 15 to 20%. Viewers, give us a call here at Oak Harvest and ask to speak to one of our financial advisors. Let us help you craft a financial plan that meets your retirement goals and your needs first and your greed second. Give us a call here at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and have a blessed week.